Welcome to morning clients and dealers. Welcome to today's morning call. I'm Joshua, the head of research. Today we're going to run through some of the earnings that have come out so far, and we will be giving an in-depth analysis on SATs. Our disclaimer. Okay. We're going to start off with Singapore Exchange, so I'll let Ben Ong, the covering analyst, speak about this.
Hi, good morning, everyone. So I'll start off first with SGX, right? So they announced their 2Q earnings sometime in the third week of January. So currently our rating is still maintained at buy, and the target price is $7.67. So just a brief run through of their results for the second quarter. So which is last quarter of the calendar year, seasonally a weaker quarter. So, but their results still beat our estimates for a net profit of 75 million, and revenue was 164.6 million. All right, expenses was lower than expected. Right, our sentiments are that we are still positive on SGX in the mid-term wise. Right, in the near term, the performance is still very much dependent on the market volumes and the daily average traded value for securities. Right, so what we are positive about is that the securities revenue should be higher in the midterm, right, because of the improving market sentiments for global markets. Right, secondly, which is one of the strong key points, is that the derivatives revenue has been showing very good traction in terms of growth, as well as the revenue being brought in, right, and the new equity index futures, which are the Thai futures and Philippines futures, which should continue to drive growth in derivatives revenue. So currently, the derivatives revenue has taken up about matched in terms of proportion wise, has matched the securities revenue, about 30% each, right, and stable and attractive dividend yield, right. The payout ratio is about between 80 and 90%, right. And currently, what's in the news is that SGX has proposed some new fee region structures, right, for the retail investors. The clearing fee has been revised downwards from 0.04% contract traded value to 0.0325%. All right. So in the near term, we think that some of the other regulatory measures, such as the minimum traded price that's being proposed, as well as the minimum collateral required, might dampen some of the market sentiments in the near term. Right. But in the long term, I think this should promote a healthier securities market. Right. And currently, for valuation-wise, the PE for SGX is already trading below one standard deviation for a 5-year average. So the valuations are looking really attractive. Next up, for the three banks, they have reported their earnings last Friday. Right. So for DBS, again, our call still remains at accumulate. The target price has been revised slightly downwards to $18.48. Right. So in terms of their earnings-wise, the net profit actually missed our expectations by a little bit. So they posted a net profit of 802 million. This is excluding the one-off gain that they have divested in Bank of Philippine Islands, which is about 447 million, right? Which is we brought in two tranches. So the first one was 221 million for last quarter, fourth quarter, and then the remaining amount will be this current quarter, first quarter of FY14. Right. So loans growth still very healthy at 3%. Q-on-Q. Total loans growth across the year is 18%, and going forward, the management expects 8 to 10% loans growth for FY14. Right, fees income again continue to show very good strength and traction, right, being driven by the wealth management fees as well as trade-related fees, very strong. Right, final dividends of 30 cents be declared, so the full year dividend is 58%, which is up 2 cents year on year. So our dividend yield has went up to about 3.5%. Right, so DBS again is our top pick for the Singapore banking sector, right, because they are a strong deposit franchise where they have a cheap funding base, should makes them well positioned for a rising interest rate environment, right, and less susceptible to volatility from the ASEAN markets, right, because they are least exposed as compared to UOB and OCBC. Next up, for UOB, again maintain our accumulate rating. Target price is now revised slightly downwards to $22.33. Okay, net profit has beat our expectations as well as consensus on higher net interest income, right, because their loans growth was surprisingly strong in the fourth quarter. Again, special dividend has been declared this year, and base dividend has been raised to 50 cents. So currently, the total dividends is 75 cents, so it's error here. right, and 5 cents higher than FY12. Right, so the dividend yield has increased to 3.8%. Okay, and they are maintaining a payout ratio of between 40 to 50%. Right, UOB, as we have always reiterated, right, is their resilient earnings, which has shown again in the fourth quarter, which is traditionally a weaker quarter. Right, and their overseas growth has been showing very good traction as well in the ASEAN markets. Okay, so again, although UOB has been showing very good regionalization agenda, right, pushing for overseas business bank growth, right, we are still a little bit more conservative because of the exposure to ASEAN, especially for Thailand. OCBC, again, we may still maintain our neutral rating. Okay, target price again revised downwards to $10.17. Okay, so their results has beat estimates as well as the market consensus. Okay, because their loans growth was surprisingly strong, similarly to UOB for the last quarter. Okay, but again, what we don't like about OCBC is the volatility because of its insurance contributions from Great Eastern. Right, so the mark-to-markets and the non-participating funds were actually eroded some of their profits. Right, but the core banking remains strong, and the loans growth, the management is pretty optimistic about it. Right, about in FY14 as well. Okay, the bank assurance model and fees and commission is showing very good strength as well. So the Bank of Singapore is driving their wealth-related fees, and the AUM is building up quite strongly. Full year dividends are 34 cents, 1 year higher than previous year. Okay, so but the thing is, what we feel that the market and the investors are still very much, will be very much focused on their acquisition efforts for Wing Hang Bank, right, which potentially might lead to earnings dilution. Okay, so that's it for me for SGX as well as the three banks.
Hi, Joshua here again. Colin, the covering analyst for telcos, is not in today, but I will take you guys through the results. Okay, M1 is our top pick for the telco sector. This is because of strong data monetization from the mobile fixed services. Okay, and there's also going to be an increasing fiber broadband customer base. Now, the thing about M1 as opposed to StarHub is that StarHub does face headwinds in the pay TV broadband side, right? Because of fiber coming into the picture. M1 does not face the same problem because they never had it before, whereas StarHub, even though they had decent results from pay TV and broadband, we think that a structural change has occurred, which will actually benefit M1, which will be coming from a low base, right, of fiber, whereas StarHub will find that fiber is competition to its pay TV. That said, StarHub did put in a decent results, and they also have data monetization going for them, which all in saw a 3% increase in net profit. Before we go on to Singtel, I just want to reiterate that StarHub again is the top pick for the telco sector. Singtel is a neutral, also decent results, but and higher contributions from associates and JVs. However, there is currency headwinds. Currency for its associates and JVs, and also Optus. There is greater competition, which was leading to lower earnings this year, and for that we are neutral Singtel, which was a downgrade from QLink. On the technology front, we are very positive on the growth prospects of Silver Lake Axis, which has saw more than 20% year-on-year increase in net profit. I think that is also our full-year forecast, that double-digit growth in net profits. Now, what Silver Lake Axis does is that it handles the core IT systems of 40% of ASEAN's largest banks, which is a very strong position. It's a very sticky position. Banks are not likely to just change their core banking solutions. So the Silver Lake earns a lot of recurring income from that as well. So it's a really strong economic moat. And not only that, it is poised for growth as well. As these regional banks increase their footprint, naturally they would also buy more services from SATS. There is also a potential kicker from OCBC. If it does acquire Wing Hang Bank, it's quite likely that Wing Hang Bank's IT backroom will have to be overhauled for Silver Lake system, and that would mean more earnings. Other possible catalysts this year would be a 300 million RHB contract and listing of its associate in China. Okay, I'll move you on to Nicholas, who will talk about Keppel Corp.
Hi. Over at the offshore marine space, Keppel Corp announced stable margins, O&M margins for 4Q13 above 14%, and despite the disappointment in the infrastructure segment, 4Q O&M margin is at 14.2%, bringing the full year FY13 margin to 14.7%. Order book hit a record high of 14.2 billion as at end of 4Q13. And year-to-date order win is at $1.1 billion with 4 KFLB class jackup rig orders this year. We expect Keppel to win to secure a $7 billion order wins in 2014 this year. So currently Keppel is also building its drill ship. This is we view it as a positive thing, as Keppel is trying to diversify into other product segment. This should put pressure to its Korean peers, which has always been specialized in the drill ship market. We continue to like Keppel for its reasonable margins over the next 2 years, supported by the execution of the repeated designs of its KFLB class jackup rigs. Secondly, it's also because of its healthy order book with earnings visibility to 2019, and its attractive dividend yield of more than 4%. We have a target price of 12.34 for Keppel Corp and an accumulate rating for Keppel. As for ISRA reported its first Q14 earnings last month. Its subsea business remains profitable for the second consecutive quarter. However, its 4Q gross margin was slightly lower at 14.9% versus its previous quarter of 17.9%, which according to management was due to the seasonality of its subsea business. In addition, management has also appointed JP Morgan as an advisor for its EMA's AMC division to improve its international profile and access to capital, which in turn should unlock value for its shareholders. Previously from the management meeting, we understand that management is actually looking into listing the ITMA's AMC business over in the US side or the European side. So this, if it's successful, should unlock value for its shareholders, and we will keep on monitor the situation over at ISRA and keep you guys updated. Currently, we are still maintaining our rating as neutral for ISRA, as we believe that it's too early to turn bullish on the stock due to its continued execution risk faced by the company itself for its subsea business. Next.
Hi, Joshua, I'm back again. Kenneth is not around today, but I will talk about Sin Heng Heavy Machinery for him. Sin Heng's results were a disappointment. Despite trading revenue going up, rental revenue was going down. That was really, but we do note that that is mainly due to short-term booking of projects, right? Because there was some delay in projects, so rental revenue was down. However, I think top line is pretty safe, but the problem was that 2 issues. One was regional expansion is demanding more operating expenses, right? And this FX hedging has produced an unrealized loss of 2.86 million. Now, if you take out the FX hedging, then really net profit has actually increased 5% year on year. Now, regards to this FX hedging unrealized loss, actually it is reversible upon delivery of the goods, right? So basically, a customer has ordered Japanese crane and they hedged the position at that price. However, due to the depreciation of the yen, they book this unrealized loss. However, once they deliver the cranes, it will be delivered at the price at which they hedge, and that means the unrealized loss would be reversed. Okay, so we tend to see that as temporary. However, there is an increased admin cost due to regional expansion, which is a slight concern. However, so based on that, Kenneth has reduced his target price by 1.5 cents to 25 cents. And based on today's price, he still views it as an accumulate. Bowsett Singapore, which I cover, had a solid third quarter. Earnings appears to have dropped 30% year-on-year, but that was really just due to two massive one-off gains, which was a disposal gain and a tax write-back. So if you readjust for all these non-recurring items, actually core profit for the 9 months has advanced 6% to 54.2 million from 51.2, in line with our forecasts. This is what's driving earnings is a same story. Basically, oil refining capex worldwide is in a recovery. Real estate design and build has record high order books, so that division is very busy with contracts on hand, as well as building up Bowsett's industrial portfolio. We continue to rate Bowsett as an attractive value buy. Now, the present portfolio has there are plans to REIT it. Now, in 2 years, it will be worth 50% of the market cap at a 7% cap rate. Right now, the floor space is about 94,000 square meters, and it's being built up as we speak. And within the next 2 financial years, that portfolio will be completed, and at a 7% cap rate would be worth 50% of the market cap right now. Net cash is already worth 20% of the market cap, which means that it's trading at 3.5 times PE on a forward basis. Extremely good value. Okay, I'll pass you on to Carolyn for global logistics.
Hello, this is Caroline. I'm going to talk about our global logistics GLP. They released their results last Friday. Our rating for global logistics still maintains at neutral. The last closing price last Friday is at 2.80. Our target price is at 2.92. GLP revenue for the third quarter of the financial year 14 decreased by 1.5% from US 173.5 million in the third quarter of financial year 13 to about US 171 million in the last quarter. The decrease was mainly attributed to the sales of the properties in Japan to GLP JREITs in the fourth quarter of the financial 2013, and the weakening of the Japanese yen against the dollar, which averaged decreasing by about 24%. However, the PATMI in the third quarter of financial year 14 has increased by 56% year-on-year from US 113 million to US 176 million due to the higher profit contribution from the jointly controlled entities and the lower financial costs. After making adjustments for the property sales and the FX movement, the revenue and the PATMI would have increased by 29% and 42% respectively. New listing activity for China and Japan in the third quarter of financial 14 is 485,000 square meters, which is an increase of 51% year-on-year basis, and 197,000 square meter, about 140% year-on-year increase respectively. The rental growth on renewal for China has achieved about 9.5% year-on-year on renewal. Looking forward, the rental in China is expected to remain steady considering the demand and supply dynamics from the slowing China economy and the limited modern logistic facility supply available in China. For Japan, there are signs of rental upturn with the increasing demand from the recovering Japan economy. However, our main concern is that the net profit of GLP may be further mitigated from the further weakening of the Japanese yen. Thanks.
Hi, good morning. I'll be speaking on SATS. We currently have an accumulate rating on SATS and target price is 347. Last week, SATS released their third quarter FY14 results. What we saw is that all their operating statistics relevant to their Changi Airport business went up except food solutions. Except for meals produced, this resulted in their revenue dipping modestly 1.1%. As we said before, it's mainly due to food solutions where they lost the Qantas contract as Qantas has bypassed Singapore on their Europe route. But this decline in revenue was partially mitigated by an increase in gateway services revenue. Operating profit for SATS declined as manpower costs pressures still remain. And finally, net profit also declined, but this decline was mitigated by good performance from their associates and JVs. Looking forward, we don't think that the year-on-year decline in meals will go on for much longer, and it should only persist for one more quarter after 4 quarters of the effect of the loss of Qantas has run its course. We also believe that the higher staff costs should not be spiraling out of control as SATS has put in place some productivity enhancing measures. As for their JVs and associates, management has guided that they are also expecting further good performance from them, and they have highlighted that they are particularly optimistic on the Middle East, Indonesia, India and China JVs. We also expect to see EPS growth for SATS with the acquisition of Singapore Cruise Centre. Okay, and so now we have recently reinitiated coverage on SATS, and we wish to update you on the outlook for SATS. So today, this is the overview for today's presentation. We'll start with a company snapshot followed by the background of the company, going into detail on their business model and what's in the pipeline for the future projects for SATS and the outlook for SATS with the global economy, and finally wrap up with the key strengths for SATS, opportunities for growth and the investment merits for SATS. Closing price for SATS last Friday was $3.10. We currently have an accumulate rating on SATS with target price of $3.47. Okay, a bit of the history of SATS. SATS originated from Malaysian Airways in 1947. Back then, they provided ground handling services at Paya Lebar Airport as a department of Malaysian Airways. After SIA and MAS split, SATS came under SIA and was incorporated as a subsidiary of SIA in 1972. Hence, SATS has a long operating history of more than 60 years already. Recently, in August 2010, SATS renamed itself from Singapore Airport Terminal Services to SATS. This was to better reflect its strategic directions and characteristics. So what does SATS do? SATS has two core operating businesses, which is gateway services and food solutions. SATS is currently the dominant player at Changi Airport with 80% market share. Through their various acquisitions and subsidiaries, SATS has also diversified into institutional catering business, and they currently operate the Marina Bay Cruise Centre Singapore. SATS has also expanded geographically through inorganic growth and provide aviation services at various locations around Asia and the Middle East. Okay, so we'll take a look at their revenue segmentation for SATS. Gateway services takes up about 36%, while their food solutions business takes up about 64%. If we look at it by industry, 81% is from the aviation industry, while about 19% from non-aviation. By geography, we see that Singapore takes up the lion's share of where their revenue is coming from, 77%, and then Japan 18%, and the other JVs contribute 5%. So if you look at how their revenue is, how the revenue makeup is coming from food solutions, aviation, and Singapore. So this is actually implying that most of their revenue comes from the Changi Airport operations. Here we have a map. You can see that the operations for SATS spans across from the Middle East to India, North Asia, down back to Southeast Asia and Australia. Okay, I'll go into further detail of all the business segments for SATS. So as I said before, SATS is the main in-flight caterer at Changi Airport. It operates 2 flight kitchens and it can produce 80,000 meals a day. The other activities related to the food solutions business is research and development, menu planning, and culinary training. In the last FY, SATS served 85% of all flights at Changi Airport and produced 28.3 million meals. SATS also has a stake in a Japanese in-flight caterer situated in Tokyo. That in-flight caterer, TFK Corp, serves the Tokyo, Haneda, and Narita airports. In the last FY, TFK served 12 million meals. Next, we move on to their aviation gateway services business. What this entails is that passenger services, cabin handling, apron services, and security. So in the last FY, SATS handled 74% of all flights at Changi Airport. That is 50 airlines, 123,000 flights, and 41.2 million passengers. So the management for SATS has recognized the volatility in revenue from aviation sector, so they have mitigated this by going into institutional food catering as well. They have acquired Singapore Food Industries in 2009, and they are now providing large-scale catering services. In addition to actual food preparation, they also distribute the food. At present, they cater for organizations such as SAF and the Home Team, and they also cater for events like the F1. And more recently, SATS has ventured into the cruise gateway services business as well. They are leveraging on their experience from the aviation gateway to manage a cruise terminal. They are currently managing the Marina Bay Cruise Center Singapore through a JV, and they are providing the cruise terminal operations, passenger and baggage facilitation, and VIP lounge management. In the last FY, MBCCS was the home port to 7 ships, had 80 ship calls, and handled 230,000 passengers. The cruise, how they earn revenue at MBCCS is through a berthing fee per ship, disembarkation fee per passenger, and rental income from the retail outlets within MBCCS. So what does SATS have in the pipeline moving forward? Currently, there's the Sports Hub, which estimated to commence operations in June this year. A JV of SATS has been awarded exclusive caterer for 21 years at the Sports Hub, and they expect 50 million in revenue annually. In addition to their cruise gateway services, SATS is currently acquiring the Singapore Cruise Center. The cruise center is already a profitable, strong cash generating business, and it reported a revenue of 45 million in the last FY and 16.7 million profit before tax. This estimates to about 0.9 cents EPS increase for SATS after the acquisition. Why SATS is so interested in going into the cruise gateway way is that once they acquire the Singapore Cruise Centre, they will effectively hold a monopoly over all the cruise terminals in Singapore. And they currently have a service called Fly Cruise and Cruise Fly, where passengers transferring between the cruise and flights at Changi Airport can check in and at one place, and their baggage will be delivered to the next terminal. Now we'll move on to the outlook for SATS. SATS will benefit from visitor arrivals in Singapore, higher capacity at Changi Airport, and growth in passenger numbers for the cruise segment. So what we have seen is that visitor arrivals to Singapore, both by air and sea, have been growing steadily over the last 10 years. And recently in 2012, both of them grew by 10%. Next, we have Terminals 4, 5, and Project Jewel. With the completion of these projects, passenger handling capacity will double by 2020. The current capacity for Terminals 1, 2, and 3 is 60 million passengers annually. After Terminal 4 is completed, it will become 82 million. And when Project Jewel is completed, 85 million. And finally, when Terminal 5 is completed, the total handling capacity for Changi Airport will be 135 million. You can see that this is more than double of the current capacity. We also seen good growth in passenger movements and commercial aircraft movements at Changi Airport over the last 10 years. This is the passenger movements, this is the aircraft movements, and SATS performance also mirrors this same trend going up. Finally, for the cruise segment, SATS is expecting greater than 6.5% growth in passenger throughput annually. The key strengths for SATS is that firstly is its competitive advantage. SATS is the dominant player with 80% market share at Changi Airport, with the ability to be a price setter. And if the acquisition of the Singapore Cruise Centre is successful, SATS will become the monopoly player for cruise terminal operations in Singapore. Secondly is network connectivity. SATS has many associates and JVs across the region, and they're able to serve customers at various locations. Reputation. SATS also has a long-standing expertise in large-scale food catering, so they are able to win contracts for major events. Lastly is their financial position. SATS is cash rich, and they are able to expand through inorganic growth. So opportunities for growth for SATS. SATS is poised to benefit from the robust growth in demand for leisure travel, and currently SATS only serves the low-cost carriers within Singapore, so they may expand to serve the low-cost carriers outside of Singapore as well. And now, with their experience in managing a cruise terminal, they can possibly expand outside of Singapore through partnerships at other cruise terminals. We wrap up with the investment merits for SATS. First is the exposure to air travel demand. Changi Airport, with the improvement of infrastructure at Changi Airport, we believe that Changi will maintain its position as the premier regional aviation hub, and we are also seeing strong, good growth in flight and passenger numbers coming to Changi Airport. With the new infrastructure, the handling capacity at Changi Airport will double by the mid-2020s. There's also growth for cruise passenger throughput, and SATS is expecting a more than 6.5% growth per annum. and as well with the acquisition of the SCC, which is EPS accretive. SATS also is in a strong financial position with little debt, and it's a strong cash generating business. We also see a growing trend of growing EPS, and we forecast an attractive dividend yield of 4.7% moving forward. Finally, we have an accumulated rating for SATS with a target price of $3.47. If you need more details on SATS, you may refer to our reinitiation report dated 5th February, where there's a company background and industry analysis, and there's more details on the recent developments for SATS. Okay, and I end the presentation for SATS.
Thanks, Richard. Okay, now we are open to Q&A. Any questions?
Hi, Benjamin here. So there's a question on our view on OCBC for the next 2 quarters if the acquisition of Wing Hang Bank goes through. So again, let's quickly run through Wing Hang Bank and how the potential synergies it might or might not have with OCBC. So okay, for Wing Hang Bank, primarily it's a family owned with much of it centered around retail banking business. So with OCBC trying to break into the Greater China market through Hong Kong, the potential benefits can get from Wing Hang Bank is really more of the branch networks that they can acquire through Wing Hang Bank in terms of within Hong Kong and southern China. So for earnings-wise, contributions to OCBC is not really very significant, but long-term wise, it's really more of a strategic acquisition, right, to attain the branch network that they require for distribution channels for both attaining and reaching out to the Greater China companies that are going to Hong Kong for cheaper financing, as well as a distribution channel for perhaps their their insurance products as well as wealth management. So in a short term wise, all right, what we expect is that with the estimated target PB for acquisition of Wing Hang Bank between 1.9 times to 2 times as reported in the media. This will definitely mean that OCBC needs to issue equity, be it within this period or within the next couple of years, right? So that they can fulfill the capital ratios. All right. So, sorry. Hi. Testing. Can you hear me? No sound. Hello. Can you hear? Oh, okay. Sorry. Yeah. So again, we expect the market reaction will be negative if the acquisition goes through at about 1.9 to 2 times PB. Because definitely the dilution factor will be there for earnings, right? Because they need to issue equity. So this is the main thing that we need to look out for. But of course, if something unusual comes in where they pay actually less than what was reported, now the market reaction might be positive.
Hi, there's a question on ISRA. Currently, our stand on ISRA is still neutral because we see that we are still cautious with its subsea business as we continue to see execution risk over its EMAS AMC business, whereby they are still executing the legacy contracts. So currently, we are pretty neutral to that. We will continue to monitor the situation and keep you guys updated going forward on the ISRA situation. Thank you.
Hi, we have a question on Quartz, whether you should, client was saying that, it's asking whether we should buy or sell the stock. Okay, Quartz has had disappointing results since we initiated. Unfortunately, this was not one of our best picks. We actually have not a very positive outlook on an earnings rebound this year. So Malaysia sales are still pretty sluggish. There's not much growth potential in Singapore, and the Indonesian business is still in infancy. Having said that, valuations are low and it's been downbeaten. So we're going to continue monitoring this stock and update investors. But I think right now it's still a neutral. Okay, a question here, and why no US market outlook done today? Well, we decided we're not going to do it every week because it does not change that significantly. The outlook, well, we still think it's still a positive outlook for stocks, and this is a, well, I mean, sorry, is for the US, we still think there's one more leg down, although the larger trend is still a positive outlook for stocks. Okay, so Kenneth has not changed his position there, that he still thinks the US market anyway will have weakness till June, but the bigger trend is still higher. Can you provide a brief update on the market direction? I think we have a, I think you're probably asking about the STI in this case. I think we think that yes, there's a bit of a rebound right now. However, because we have a view that the US will probably have another leg down, we don't think that this rebound is sustainable. And but whatever weakness that comes after this is probably a buying opportunity, as the larger bull market is still on. Hi, we have a question on SIA engineering. Due to a change of analyst, the coverage stopped for a while, but we're picking it up again. And our view on SIA engineering is still positive. We still think it's a very good play that is just like, I mean, SATS, where it has a large position here in Singapore for MRO services. But the strongest feature about SIA engineering is that it has a partnership with Rolls-Royce, right? And because of that partnership, it guarantees them a baseload of MRO work from Rolls-Royce, which is a major jet engine maker. Okay, so we still have a positive outlook for SIA engineering based on the partnership and based on Changi Airport's expansion. We have two questions here, one on dairy farm and one on super. Unfortunately, we don't have coverage on those at the moment, although we do note that both of them have corrected quite significantly. We're not experts on those two stocks, but we do know that for dairy farm that it is facing competitive pressures at the moment, so which explains the PE duration in the stock. Hi, we have a question on ST Engineering. Yes, also we are looking to pick up the coverage for ST Engineering. At the moment, it is a positive outlook on ST Engineering, record order books, and also expansion in the MRO field. Defense spending, as you know, they are bulwark in Singapore. Record order books, so we are positive on ST Engineering. Hi. A question on Del Monte. Yeah, we're also looking at Del Monte. We haven't initiated yet. At the current price, it seems like not a bad entry point actually, between 60 to 65 cents. A lot of the downside has been priced in. We actually worked out for ourselves that actually on a consolidated basis, with the cost savings that they're looking at, if you believe them, it is actually trading at 17 times forward PE. Okay. So at this price, at 60 to 65, I think it's not a bad entry price for Del Monte. Most peers of Del Monte in this class, where you're actually a brand owner, you typically trade at 20 times, right? So at 17 times, it's not too bad. I noticed that, okay, question here, notice that construction companies have very low PE. Any explanation for this? Yep, the explanation is that construction companies do not have recurring earnings. They are contract-based, project-based type of earnings. So earnings tends to be lumpy, and there's no guarantee that, you will have, basically you have to keep looking for contracts, right? If you want to maintain your earnings. Which is why actually we cover like Penn United instead of construction, individual construction stocks. So basically, we are covering a supplier. Penn United is 30% of market share ready-mix concrete, right? So that has a higher PE of 10 to 12. Yeah. Okay, so a question here on Penn United. Yeah, we are still positive on Penn United. Basically, for the ready-mix concrete, yes, there's going to be resilient baseload of earnings because of the infrastructure projects that Singapore is undertaking. There's expansion of Tuas Megaport, there's the Changi airport expansion, Paya Lebar will be redeveloped, Tanjong Pagar will be City Port will be moved out and redeveloped. And of course, there's going to be massive expansion of our MRT lines. So for Penn United being a major supplier of ready-mix concrete, they will definitely benefit from this trend. So I think we'll have a resilient baseload of earnings there. The other thing about Penn United is that they have a port in China, which is a very profitable port. And they are open to further opportunities to expand the port business in China. So that is an interesting upside to the stock. Oh, question on Amara, so I'll pass you to Caroline.
Hello. Regarding Amara, earlier on we have actually spoken on this. For right now, Amara, the results are not out yet, but based on the previous last few quarters, it seems that it actually falls short of our expectations. But on the whole, we still think that Amara is quite deeply discounted. So you can actually consider looking at it, but I would suggest maybe we will actually look at the wait for the upcoming results on Amara to actually have a better view for the future. Thanks.
We have another question on Sinhing here. So what was the reason for the big drop in the stock? Yep. So we addressed this at the front part of the presentation. Perhaps you missed it. Basically, two things. They have increasing admin costs due to their regional expansion, but also they have this FX mark-to-market loss, right? So the mark-to-market loss is basically when they sell Japanese equipment in yen, then they have to hedge the position. further yen depreciation, then you will get a mark-to-market loss. However, when you deliver the goods to the client, they will deliver at you will be able to close the position at the price that you hedged. So actually, the FX position is totally reversible. On that note, I think we'll have to say that although we're positive on Sin Heng's business model and its regional expansion, we are looking more closely at its admin costs to see. Hopefully, it will not run out of line. But the FX loss is perfectly reversible. Okay, thank you. There seem to be no other questions. So we look forward to having all of you on the webinar again next week. Thank you very much.